All right, so welcome back. What we're looking at today is cost, volume, profit analysis. And we're going to be using some of the work from last week, which is very much focused on the cost side of things. And we're going to be looking at the thing or the equation that we set up at the start of today. And we'll see it again, but I see that as really important through this because effectively what we're going to be doing is manipulating that basic setup and just doing different variants of it. And on one token, on one hand, just looking and going, well, that's pretty simple, straightforward. There's not much we have to do with it. And in many respects, you're right. Once you've got that basic idea of revenues minus costs, separating out what revenues are, separating out costs into variable and fixed costs, the actual setup makes a lot of sense, but it is also very usable. So the five things we want to have a look at, and realistically the first four are the big ones. The fifth is probably not so important. The first is using the contribution margin to determine the impact of changes in sales on profit. The reason it's such a useful thing, separating it out as variable and fixed, separating it out as variable and fixed is you can very easily see what will happen to your profit or your expected profit if you just change something. Whereas if you have it in cost of goods sold and in sales and admin, a lot of things are mixed up in a way which makes that much more difficult to do. Which then leads into the second bit, which is analyzing what-if decisions using CVP analysis. It's very, very quick and easy to go, well, what happens if we set price to this? What do we need to do? What happens if we have an advertising campaign? What happens if we use a lower quality material? Like, how does that affect things, and what assumptions can we build into it? Makes that so much easier to do. 3 and 4 then take that basic setup that we talked about at the start of today, take that basic setup and then go, well, what happens if we don't just sell a single product? What happens if we have a multiple product environment? And look, I was racking my brain earlier, maybe I was talking to you guys as well about it. What type of company sells something which is not just a one-off, like just one product? Like a particular thing might have multiple products, and potentially events are actually that sort of thing. What happens if you buy a ticket to an event and it's only one ticket class, that's it. They don't sell anything else at the venue, it's just you buy a ticket and done. That potentially could be a single product company. But what happens if you have multiple products? What happens if you have different levels of tickets? What happens if you have the tickets which are sold up, they're closer to the stage, they're further away from the stage, there'll be different prices. What happens if you have different, like state? Yeah, you got different packages available, which may have different prices, which may have different variable costs attached to them. How do you then start to deal with that? What happens if you have early bird tickets which are at a discount versus later sales versus sales which happen on the door? They will all happen slightly differently. They may have different prices, but the variable cost might be the same. What happens if we have to build in tax? How does that affect what we're doing? And lastly is compute a company's operating leverage and understand its relationship to cost structure. So the first starting point is the factors which influence product. Now the first four, and I'll come back to the equation we worked out earlier today. Profit equals price divided by unit, not price divided by unit. Profit equals price per unit multiplied by quantity. That's your revenue. Take away from that all your costs, which are your variable cost per unit times quantity. Take away your total fixed cost. So on the right-hand side of the equation, we have revenues minus costs. And on the left-hand side of the equation, we have your target profit. And if you look at those factors in there, so those four which are part of the slides to begin with, the price of the product or service, that is one of the parts on the right-hand side. The volume of products or services, that's the quantity on the right-hand side. Those are two elements. Element 3 and element 4 of cost elements, per unit variable cost and total fixed cost. You have, or you get given those four pieces of information for a single product company. You just mechanically can work out profit. It's just a matter of plugging everything in. The fifth point happens with multi-product companies, although you could say it happens with a single product company as well, where it's just a 100% of your units sold are for that particular type. But you might have, like, well, I don't know, they've got lots of different classes of origin tickets, but if you've got origin tickets and they've got like 5 different classes of tickets, sort of A category, B category, C category, whatever, you'll have to look at, well, what percentage of our tickets are A category, what percentage are B, what percentage are C, and then you need to work out, well, what are the cost structures around each of those categories, and we need to do something with that. So we need to understand what the mix of the product or service is. And what we've just been doing, Damien, it's called the silent button. On the left-hand side, we've got the traditional income statement, and that's dealing with your absorption costing. That's dealing with, and we'll see in a second, sort of inventory and then selling admin costs. On the right-hand side, we've got a contribution margin income statement, and this separates costs into two things as well. But this separates cost by behavior. So we've got variable and fixed. So if we look at these, when we separate by function, within those functions, you'll have variable and fixed costs. Within these functions, you'll have variable and fixed costs. On this side, separating by behavior, you've got some of these things with different functions in there. So there might be variable manufacturing, there might be variable sales and admin. So if we actually look at it, the total costs on the left or the right-hand side, in both cases, we're taking all these costs which have happened and then separating it into two bits. If we ignore sales for a second, because sales are going to be the same on both sides, if we ignore the calculated column or the calculated rows, gross profit or contribution margin and net income or net income, we've basically separated on this side into inventory type things and just other stuff like sales, admin, HR, legal, all the rest of it. And on this side, we've separated out into those costs which vary directly with quantity and those costs which don't. So it's just a different dividing point. But for internal purposes to make decisions with, the contribution margin setup is a much easier way to manage things. Bless you. So the contribution margin per unit. So if we look at this particular case, and what I'm going to do is I'm going to draw up, it's going to use the same information that we see here. I'm just going to lay it out in terms of the equation that we worked out earlier, and that was on the slide just before. So profit, we can see that, that's a bit small. Profit equals price times quantity minus variable cost per unit times quantity minus total fixed cost. So we have 1, 2, 3, 4. So price is one input, quantity is another input, variable cost per unit is a third, and total fixed cost is a fourth. So in this case with Happy Daze, they have a $12.50 price per unit. They have a $9 variable cost per unit. They have total fixed cost of $35,000. At this current point, what they're estimating is sales of 8,000 units. And what we can see by writing all this out using that setup that we talked about earlier is everything on the right-hand side is numerical now. We don't have any unknown variable sitting there. The unknown variable is profit. The left-hand side, we're solving for this. And all you have to do is just crunch it all through. And if we amalgamate some of this, we get 1250 minus 9 times 8,000 minus 35,000 equals 350, and I'm doing this for a reason. 350 times 8,000 minus 35,000. So another way to set this up using what we've got here is $3.50 times number of units minus 35,000. That $3.50, which you can see on the slide, that $3.50 is the contribution margin per unit. So you know each unit that you sell, you will make $3.50, which will contribute to paying off your fixed cost and then going into your profit. That's what your contribution margin is. So in this case, at 8,000 units, if we work it all through, we end up with 28,000 minus 35,000. So our revenue, not our revenue, but our total contribution margin is less than our total fixed cost. Gives you a loss of $7,000, which is what we can see. And that's not a good place to be. No one likes losing money. Before we move on, just one more thing to take into account is this thing called the contribution margin ratio. The contribution margin ratio is the contribution margin, which we've just worked out. You can either work this out on a per unit or in total basis. Either way, it's going to give you the same number. In this case, we're doing it on a total basis. So the total contribution margin is 28,000. The total sales is 100,000. So that means the contribution margin ratio is 28%. What that's telling you is that every dollar that you sell, every dollar that you earn in revenue, you are contributing 28% of that to paying off your fixed costs. So the greater that percentage, the quicker you are in terms of paying off your fixed cost. So we look at this. The CEO of this company looks at this and is not happy with the net loss of $7,000. Not surprising. And thinks about what sort of options are available to increase net income. I would say while maintaining high quality products. I mean, the high quality products is a sort of separate part of it. I suppose at a base of it, what do they want to do to increase net income? Now, if we mechanically look at what we have here, this is why this setup is really important. So if we look at this top line, profit equals price times quantity minus variable cost per unit times quantity minus total fixed cost. If we want to push profit up, that's ultimately what we want to try to do. There are 4 inputs that will affect that. And you can see that just by setting it out this way, you can see that really clearly. Now, what I'm going to say is going to make some assumptions. I don't think they're not reasonable assumptions, but we're going to make them and then we're going to sort of think about them for a second. The assumption that we're going to make is if we make a change to one of these things, nothing else changes on the right-hand side. So if we change price, it doesn't affect quantity. It doesn't affect variable cost. It doesn't affect total fixed cost. The only thing we're going to do is to push price in a direction. So my question to you is, if the other 4 variables stay constant, how do we change price to improve profit? We increase price. If we assume that quantity and variable costs and fixed costs stay the same, and we increase price, we will have an increase in profit. You can see that happening because ultimately that will affect your contribution margin. You put this up, that's going to mean this number becomes bigger. And if this number becomes bigger, that number becomes bigger, which means you're going to make a bigger profit. If we're going to make more profit, is quantity holding everything else even? Quantity going to need to be higher or lower? Yeah, we need to sell more, holding everything else constant. We sell more, we'll end up with a higher profit. Variable cost per unit, lower. Total fixed cost, lower. That's making the sweeping assumption that nothing else changes. And that's so far from the truth that we basically have to ignore it as an assumption. But it's a good starting point because you can start to say, okay, if we do this, but you can see how using it as a what if or setting up in a spreadsheet, how you could do these. It's like, well, if we push price up by $1, we think we're probably going to sell we're going to sell fewer units. So let's see how that all plays out. Does that lead to a bigger profit? Well, okay, we'll go with that. But price and quantity, variable costs and fixed costs, these are going to have impacts. And you need to consider, well, if we do one, what is the impact going to be and what are potential adverse effects? So we reduce variable manufacturing costs. Companies, when they're losing money, often talk about cutting costs. Do they try to cut variable cost per unit or do they cut fixed cost per unit? Variable cost per unit, maybe they just try to find cheaper suppliers. Maybe they try to find substitute more expensive material with cheaper material. Now that certainly may well get you a variable cost per unit lower, but it may have other flow-on effects. It may mean that the quality of the product isn't as good. If the quality of the product isn't as good and it's starting to have defects and people are aware that it starts to break down or there's issues with it, maybe people will stop buying it. Or maybe they'll keep buying it, but they'll only buy it for a cheaper price. So it'll have flow-on effects. You could try to boost it by increasing your variable cost per unit by putting in sales commissions. So it gets your sales force more incentivized to go out and sell. So you're going to increase your variable cost per unit, so you're going to make less per unit, but you may sell more units. So you need to look at where the sweet spot is there. You may decide to have an advertising campaign. So you just have a bigger fixed cost, but that means you've got a bigger hurdle to jump before you start making money. So there are things you can certainly do, but you need to look at all the consequences of them. And that's just more of the same. So if you've got an inferior supplier, what does that do to what you're producing? If you've got more breakdowns, you have cheaper workers, more inexperienced workers. They're cheaper, variable cost per unit may go down, but then they're probably going to spend longer doing it. So that actually may push variable cost per unit up, who knows? Ultimately, a lot of this, and one of the key points a lot of businesses want to know, is where do we break even? What do we need to do so that our profit is zero? Above that, we're making profits. Below that, we're losing money. So the break-even point is the level of sales at which the contribution margin equals fixed cost. Therefore, net income equals zero. The break-even in units. So if we can think about break-even in both units and sales, personally this is just the way I think about it. Personally, I like to think about it in units. It makes more sense. It's like you sell a certain number of units. That'll break even. But you can also think about it in sales. Now, to get to units, we do fixed costs over contribution margin per unit. But what I'm going to do is actually step us through how we do that using this setup, because it actually will lead to the same point. The break-even in sales, you can do fixed costs over the contribution margin ratio. Personally, you can just work out the break-even in units and then multiply it by price and you'll get the same thing, but each to their own. So if we think about Happy Daze, fixed cost of $35,000, a contribution margin per unit of $350. A break-even point in units is your fixed cost over your contribution margin per unit gives you 10,000 units. I'm going to get you to do some of this in a moment, so just bear that in mind. So how does this look with this setup? So imagine we've got profit, and so we've got four variables on the right-hand side, and we've got profit being the fifth on the left-hand side. Now in this case, if we want to actually find a target profit, this is a known number. We put 0 in, because that's the break-even we want. Price is $12.50. Quantity is the unknown, minus variable cost per unit of $9 times quantity minus 35,000. We aggregate this, so we get all the quantities together. We end up with $3.50 quantity minus 35,000. We deduct 35,000 from both sides. We end up with 35,000 equals 350 quantity. Swap sides. 350 quantity equals 35,000. Divide by 350, so we just get quantity on its own. And actually, I'll just be a little bit pedantic here. I'll just put in 0 to make it very clear, because that'll be useful later on. What we've ended up with down here, the break-even quantity, is your fixed costs divided by your contribution margin, which is exactly what we had up there. I've just worked it out from this setup, just so you can see that this setup is actually the core of everything that happens. I've kept the 0 because this is actually going to be important when we're starting to target particular profits. So we've got 0 here. When we add 35,000, we've got the profit, which is 0, plus 35,000 equals 350 quantity. Flip it all around. And then we've got quantity equals your fixed costs plus your profit. Just happens to be 0 when you're breaking even, because that's the target profit that you want, is 0. Divided by 350, that all works through to be 10,000 units. If we wanted that in sales dollars, you divide it by 35,000 by the contribution margin ratio of 28%, gives you 125,000. You could do it that way, or you could take the 10,000 units that you need, multiply it by the $12.50 price, and that will give you 125,000. Either way will get you the same thing. If we were to graph this out, and we've actually been dealing with functions, so if you think about the cost curve, that cost curve has an intercept, so it has some sort of fixed cost there, and then it has variable costs, so it's moving upwards. The revenue line does not have a fixed component to it. You sell nothing, you earn nothing. So it starts at the origin. And you'd really like to hope that this is the case. Its slope coefficient, its slope is steeper than cost. Now that's a really good thing to know, because if it wasn't, and if it never intersected, there would be no point where you're going to make money. You need that to intersect, because that intersection is the break-even volume. Anything in between the curves, this area here underneath break-even, that is how much money you're going to lose at that particular amount of volume. This is how much money you'd make for that level of volume. And you can obviously see how, if you were to increase the price per unit, that would change the curve from here, and it would change the slope coefficient on the line, and it would change it to there. And you could see by just physically changing like this, the break-even moves backwards, and you now have break-even at a lower volume. If you change the price so it's a lower price, it's going to push the break-even point to the right on that graph. And so that's graphically where you can see it. And certainly if you work out all these cost functions and the revenue function and put it into Excel and run it for different different levels of volume, you can create graphs like this and see how it all works and work this stuff out. And that's where doing this stuff is really good for sensitivity analysis. So lecture demonstration question 10.1. Well, I've done one. So what I want you to do, this should take you not very long. You can pretty much do it. I don't reckon you need a calculator to do this. I reckon you do this just in your head. $10 selling price, $6 variable cost per unit, $4 per unit contribution margin. Your fixed costs are 50,000. How many units do you need to sell to break even? So I'll step through it. So break even point, profit is 0. Price is 10. Variable cost per unit is 6. Total fixed cost of 50,000. 50,000, add 50,000 to both sides equals 4x. Swap it over. 4x equals 50,000. X equals 50,000 on 4 equals 12,500. You need to sell 12,500 units using that cost structure to break even. Less than that, you are losing money. If you want out the break even in dollars of sales revenue, would be contribution margin ratio, and take the total fixed cost and divide it by that. Total fixed cost of 50,000. Contribution margin ratio is, in this case, 40%. Have I done this right? Yep. And that is mental blank for a second. 125,000. So I was just having a moment. 50,000 divided by 4 gives you break even. 50,000 divided by 0.4 gives you 125,000. The other way to get that is to take the number of units, multiply it by the selling price, gives you 125,000. You could do it either way. But that's all well and good to do it with one type of unit. But what happens if we have 2? What happens if we have 3? What happens if we've got 100? It's still doable. We don't just guess it. It is still doable, but there's one other thing that we need to know to be able to make this work. And we need to know what the mix of our products are. We need to know, is it a 50-50 mix? Is it 90-10? Is it 70-30? We need to get that mix to be able to do a lot of this. So to do this, we're still getting the break even is fixed cost divided by contribution margin per unit. That structure is still the same. What's different is that we aren't using a single contribution margin. We're using a weighted average contribution margin of all the units that you sell. Now, it's not a simple average. If it was an even split in products, 50-50, or 33-33-33, or 25 for 4 products, or so on, then you could use a simple average. But we need to weight it by the proportion of the products that we sell for each particular class. So let's say that we have a new product being brought in, and that new product, I don't like the word invest there, I'd probably use more, it has a fixed cost of $15,000, and they're going to sell 4,500 units of this, or they expect to sell 4,500 units at $15 with $11 variable cost per unit. The old game has 8,000 units. The new game is expected to have 4,500 units. We've got all this set up, but in a sense, we don't need a lot of this. What we need is the contribution margin per unit for each of those things. So we have the $3.50 and we have the $4. Now, if we were to just take a simple average of that, would just be $3.75, halfway. But the problem is that assumes that your sales mix is 50-50. You sell exactly the same number, or you expect to sell the same number of both types of units. If you don't, or you expect not to, then that's not going to work out. So what we have here is an expectation that you sell 8,000 of one and 4,500 of the other. So when you work it all through, you have about 64% of your sales have a contribution margin of this, and 36% of your sales have a contribution margin of $4 a unit. So the weighted average contribution margin of each one is a 64% of $3.50 gives you, I think it's about $2.24, I should say. So the weighted contribution margin is $2.24. The weighted contribution margin over here is $1.44. Add those together, and we end up with $3.68. And now you have a contribution margin. It's weighted across a couple of units. It's assumed that that sales mix will actually happen. So you've got an extra thing you need to figure out. But apart from that, you now have a contribution margin. And we already know how to calculate break-evens using contribution margin, because it is the total fixed cost divided by the contribution margin per unit. We have 368 as contribution margin per unit. In this case, we have the fixed costs, not at the original 35, the fixed costs have increased to 50 because we've got the additional fixed costs for the new game. And we end up with 13,586.9. So we've taken what we've done originally, we've taken that basic setup, just what we've got here, which everyone was comfortable with. We did that at the start, everyone looked and go, yep, good with that. And we're just slowly layering some complexity onto it. That's all that we've done. Two comments about the break-evens for the moment. What we've just calculated there. The first comment is, we calculated 13,586.9. We have rounded that number. Why do we have to round this number? You can't sell a part of a unit. Yeah, so exactly right. You can't sell a part of a unit. So it has to be a round number. Sorry, it has to be a whole number. We always have to round up. So in this case, it's not so self-evident because 0.9 would round up to 87 anyway. But if you have 0.1, you would round up to the next nearest whole number. And the reason you do that is if you were to round down to 86 in this case, you'd be making a very slight loss. So you haven't, you could hit that target and you're losing money. It's like, well, hang on. I got told that was break even. It should be good. It's not. You always go, if you can get zero, hit zero, or just that one unit that will tip you into profit. So those are the two things which are really important about break even calculations. Another comment which is important for multiple unit calculations is that 13,587, that is the calculation of the total number of units. That's not old or new, that's old and new. So if you want to work out the actual total of old games or new games, you'd have to then go in and count, separate that out into the old bit and the new bit. If the sales mix changes, we had 64-36. If we change it to 50-50, this would then become, instead of being $2.24, it would become, what's that, $1.75? And instead of being $1.44, it'd be $2. and the new contribution margin becomes 375. So changing the mix slightly will change the contribution margin. Now what you can see from that is, as we expect to sell as a proportion more of the higher contribution margin units, the weighted average contribution margin starts to shift more towards the $4. So it's gone from 368 to 375. As you increase the contribution margin, whether a weighted contribution margin or just general contribution margin, your break-even point will lower. Because what's happening now is you're getting 7 cents more per unit to pay off your fixed cost. So your break-even point has to reduce. And in this case, it's reduced down to 13,334 units. Separated out, you're selling 6,667 units of each of the old and the new. Just what we were saying, as contribution margin increases, the break-even point will decrease. But think about this for a second. I know it's talking about weighted average, but contribution margin is price less variable costs per unit. You can get the contribution margin increasing, putting price up, holding variable costs constant. That will increase your contribution margin. Your variable cost per unit could go down, and this stays constant, and that will increase your contribution margin. You could do them both at the same time, and that would really increase your contribution margin. So this is how some of these things drive into profit. But you also need to take into account that if you put your price up, your contribution margin per unit will increase, but you are likely to adversely affect quantity. That will likely come down. So you need to start to look at modeling how that all works in reality. What's that? Yeah, I'm doing this on a per unit basis. So yes, contribution margin per unit is the price. So if we were to take, say these coffees sell for $3, they could put their coffee price up to $4. They may see a decline. They'll make more if their variable cost structure, if their cost structure stays the same, they'll make more contribution margin per unit. They'll make an extra $1 per unit. But then you also likely see people go, well, hang on, $4 is starting to get a bit steep. People will start to substitute that for something else. And so you're going to see quantity drop, and then that's going to have that effect. See, this is a beautiful thing about this setup. If they are targeting a profit of $100,000, what must it sell? That is the same thing here. And I won't do all the working out on this, but I'm just showing you how easy it is to then use this setup. If we ignore this bit for the moment, if we ignore this, so this is for break even. We've got a zero profit. But hang on, we want a profit now. There you go. And we just solve it for that. And you work it all through. And what you end up with is the sales volume, or the units that you need to hit a before tax profit. So this is a profit before tax, is your fixed costs plus target profit all over your contribution margin. It's just rearranging it now that you've got profit in there. It's 35,000 plus 100,000 divided by 350. Really straightforward. So now that we want a profit of $100,000, 38,572. That is the number of units we need to sell if we want to make a before tax profit of $100,000. If they want to earn a $100,000 profit, target profit after tax, we need to take into account that we are going to get taxed 30% on the before tax profits that we make. So what we need in here, if we're thinking about this setup, is this profit figure here is before tax. You can't just throw an after-tax profit in here and work it out. It won't be right. What we need to do is find out what the before-tax profit would be based on the after-tax profit that we want. And the way that you get that is to take the before-tax profit is equal to your after-tax profit divided by 1 minus the tax rate. Because your after-tax profit, basically what ends up happening is your before-tax profit, you get to keep a certain percentage of that. The government will take in income tax a certain percentage of that. In this case, it's a 30% income tax rate. So what we get to keep is 70%, or what the government keeps from that is 30%. Unless you're a multinational corporation who's managing to offshore your profits, and then it's a completely different story. But it's 100,000 divided by 1 minus 30% gives you 142,857. So if you want an after-tax profit of $100,000, you need a before-tax profit of 142,857. Now, a way to check this, because I get slightly worried when I'm doing this sort of stuff that I've calculated it wrong. So a really good way just to double check it is to do this. Net profit before tax. Okay, we've calculated 142,857. Take away tax. Then I get out my calculator. Tax rate's at 30%. I'm going to do this, if I can find my calculator. 142,857 times the 30 is 42,857.1. So net profit after tax plus 142,857. I've lost, you know, if I was going to make $100,000 after tax, I don't think I'd be quibbling about, I may be an accountant, but I don't think I'll be quibbling about that sort of an amount. So you know what? I do it, I work it back in, I double check it, and I go, that makes sense. Because if you're just unsure about using that formula, you go, well, I don't really know if that's the right number. You can double check it, and you can do it and you go, yep, that all lines up. Away we go. Sales volume to reach an after-tax profit. The thing is, now that we've got our before-tax profit, the $100,000 after-tax profit is equivalent to a before-tax profit of $142,000. So all that we do is we throw the $142,000 in there, and we're done. 142 plus 35,000 divided by 350 gives you 50,816 units. Which then brings me to the second lecture demonstration. This is going to be for you guys to do, because I've done a few of them. We've walked through some stuff. Selling price of $40. So we've got a dishwasher and what is it? Walter White. I don't think Walter White sells dishwashers and washing machines, although he was laundering some things. He was laundering things at some point. And is considering whether to expand its operation interstate. All products have identical costs and selling prices. You have a selling price of $40 per unit, product cost of $25, sales commissions of $5 per unit. You have $20,000 in annual fixed costs, a tax rate of 30%. Part A, calculate the contribution margin and contribution margin ratio. So we have a contribution margin of $10, price minus variable costs. Price of 40 minus variable cost of 30 gives you $10. Contribution margin ratio is 25%. The annual break-even point, just do it in units. Annual break-even point with a $10 contribution margin and a $20,000 annual fixed cost. Break-even equals fixed cost divided by $10 contribution margin gives you 2,000 units. If you wanted to figure it out, the sales volume, you could take that and multiply it by 40, which would give you 80,000.
So what's the 80,000? That's the dollars.
That's the dollars. So that's the number of units, and that's the dollars. Or you could do it as 20,000 divided by the contribution margin ratio of 25%. That gives you $80,000. Okay, so how many units need to be sold in order to earn a profit before tax of $10,000? 3,000 units is it. And again, it's following the same basic setup of total fixed cost of 20,000 plus target profit of 10,000, all divided by 10. Gives you 30,000 over 10, gives you 3,000 units. So yeah, for C, if you want a profit before tax of 10,000, you need to sell 3,000 units. Now, profit after tax, I'll work through this one, but a profit after tax, and if you already jumped ahead, that's absolutely fine. A profit after tax of 14,000, we need to work out the profit before tax. So a net profit before tax is the net profit after tax divided by 1 minus the tax rate. So in this case, 1 minus the tax rate is 70%. So net profit before tax equals 14,000 divided by 70% equals $20,000. And then you just put that in just like what we did before. So it's 20,000 plus 20,000 gives you 40,000 over 10, gives you 4,000 units. You can see how it just works its way through. And all the solutions are there as you need it if you want to have a look at it in more detail. Now I understand we're getting towards the end, and I'm going to leave a little bit of time for questions, and I'm not going to talk a huge amount about cost structure and operating leverage because it's not something that we will focus on. But the one thing I just want to draw your attention to, the idea behind it, is we have two companies. They say they're highly automated and highly labor intensive. That could be the driver of it. It could be other things going on. What we're looking at, or what operating leverage and cost structure is looking at the mix between variable and fixed costs in an organization. So you could go, I'm just trying to think of an example of this. Off the top of my head, mine's gone blank. I mean, you can think of examples where you have, actually a lot of the supermarkets are going a little bit this way, where they've got automated, you could have an old school supermarket where it's got people at the checkouts, or you could have a new one where it's got automated checkouts. There's probably a higher fixed cost with some of that, but actually the people are going to be fixed costs. And that's why I think this is not the perfect example, but should have thought about this. But anyway, you can have a highly automated situation where you've got maybe people on a production line. And so there's people on a production line actually making direct labor. They're actually making things, so they're going to be involved here. And less machinery. In this case, you've got more machinery and less labor. Same sales, same net profit. What we're looking at here, though, is the contribution margin is higher. You make more per dollar of sales to pay off your fixed costs when you have in company A than company B. What that means is company A, as they get changes in sales, whether it be an increase in sales or a decrease in sales, their profit is going to move up and down faster than for company B. So if we see a 10% increase in sales, we see profit go up by $16,000 for A, but it only goes up by $12,000 for B. Whereas the reverse happens where if you go down, it goes down faster for A than it goes for B. So A has a decrease of $8,000 versus a decrease of $6,000 for B. What does all this mean? Well, you got to think about this is coming back to what they call operating leverage, and I'm going to leave this with you guys to have a look at. What a higher leverage does is it means that profitability is going to be more sensitive. The more sensitive it is to changes in sales volume, I don't know, maybe you want to be sensitive to changes in sales volume, but that can have a detracting effect. So operating leverage for company A is going to be 2 times. Operating leverage for company B is going to be 1.5 times. As you get closer and closer to the break-even point is 0 profit. Your income becomes very sensitive to changes in sales, and it'll mechanically work out that way. And some of the best things to do with this is actually go back, have a look at what the textbook says about it, but I wouldn't spend a huge amount of time doing so, because it's not going to be an area which we stress much about. It's just to be aware that if you come back and look at this is probably the thing to take away from it, and then we will call it a day. Think about your contribution margin, think about your fixed cost. If we're thinking about this, and I don't know how many units we've got here, but if we think about this has got a higher contribution margin per unit. We can see that. Say it's the same number of units that we're selling. Company A has a higher contribution margin per unit. It's got 160 as compared to 120. So for each sale that company A makes, it is going to get more towards its fixed cost and then into profit. So it will pay off its fixed cost quicker per each unit. However, and this is the thing to be aware of, it has got a higher hurdle in terms of fixed costs. It's got more fixed costs there it's got to pay off as compared to company B, which is fewer fixed costs to pay off, but then it contributes more slowly to profit. So I don't know, it just depends on the type of business. It depends on, how, I don't know, I suppose how sensitive you are to those price changes as sales volume changes. But it's something just to have a look at.